Hi, everyone, and welcome to the latest episode of Coinscrum. My name is Chris Bendiksen, and I'm the head of research at CoinShares, Europe's largest digital asset manager and home to the legendary XBT provider, Bitcoin exchange-traded certificates. In today's episode, we have a Bitcoin halvening special on mining economics, and to cover that topic in the sexiest detail possible, I have two excellent and distinguished guests with me today. Pavel, who is the co-CEO of Braiins SlushPool, and Dr. Philipp Kallerhoff, who is the CEO of Protos Asset Management. Welcome, guys.
Hi, everybody. Thanks for having us.
So before we get into our excellent list of topics, why don't you both give us just a quick bio explaining how you ended up on the show today, and we can start with Pavel.
Yeah, I'm here probably because we are running as a company SlushPool, which is the first mining pool in the world for, let's say, we do it 7 years already. So we have some in-field experience with mining, and halving is about mining. So this is the reason why I ended up here, obviously.
Excellent.
Yeah, so my name is Philipp Kallerhoff, and I am the CEO and CIO of Protos Asset Management. We are running crypto hedge funds. We've done one of the first tokenized security token hedge funds in the US in 2017. And we have been running crypto trading strategies since then. And we have one of our major clients are mining firms, and we are operating for them difficulty swaps as well as Bitcoin hedging strategies. So kind of locking in certain yields coming from mining from that.
Cool. Excellent. So why don't we start with just a little bit of a comparison of the current landscape versus the last halving. So it's been 4 years since the last halving. Pavel, how would you say that the mining industry landscape has changed since then?
I think the biggest difference is size of miners. We could see a large shift towards bigger and more professionalized miners. The tendency was visible even before, but the last 4 years, it's very significant shift towards industrialist miners, like big companies, publicly traded companies. This is the biggest shift, I would say. More sophistication on all levels, every single detail, and the whole process of mining as more detail is scrutinized and tried to be as efficient as possible. And this process is continuing. And
and on the hardware level, right around the last halving is actually when the venerable Antminer S9 was released, and I think we can say that it served those who got into the mining space around then pretty well. And so right now we have the S19s, we have the M30s being released. Do you guys think they will offer the same kind of risk moderation to new entrants now as the S9 did back then?
Yeah, I would say we can basically expect the similar thing with the new generation of hardware. Just a quick note, S9s are still profitable after halving if the price is on 9K level roughly, and the difficulty is not going up very, very fast. But it's really edgy thing. But we can expect that the new hardware will completely replace the S9s and do similar stuff, because like nobody expects huge improvements in mining efficiency as we could see last years. So yeah, I would say it's very similar situation.
I mean, from maybe just jumping in there. So since we have kind of advised a lot of miners, and we have advised public mining companies, obviously, with very, hundreds of thousands of rigs. And of course, like you said, right, with the S9 machines, they had a huge bull run that kind of turned over, of course, in 2018 when Bitcoin dropped, and they all became partially unprofitable back then already. Then they came back in 19, and now with the new machines, obviously, there's a new generation. So that's super interesting. But I think what we have to keep in mind is that they were extremely profitable because the Bitcoin price rallied after the last halvening, and that obviously had the big impact on profitability not if we assume that the Bitcoin price would have stayed the same, then of course that profitability would have been way different.
And do you guys think those two play into each other?
Pardon?
Do you think the profitability of mining plays into the Bitcoin price in any way? I know Matt D'Souza has been very forward about this concept lately. And to give viewers like a quick recap of his argument, he essentially says that when mining profitability is excellent, fewer coins end up hitting the market, which constricts the ongoing supply further, which tends to create a virtuous cycle and feed into any ongoing or budding bull market that we have happening at the same time. How do you guys feel about that theory?
Yeah, I mean, I know Matt quite well. He was at our conference in January here in Zurich. I've just chatted with him just this week about another difficulty hedging over the halving. And I really like his argument. The question, of course, and it's a great argument. I think that is partly true, at least for the miners that we work for. That of course they take more market exposure if they don't have to sell all the coins to kind of keep the company running. On the other hand, I think we will see a massive, the halving is going to happen, and you will produce only half the coins. So therefore, their profitability will drop unless Bitcoin, like you said, right, will go to 9,500. And then they will have some flexibility. But overall, I think they have now more free coins, of course, than they will have next week, right? So already that, I think, will have an impact, and they will, obviously they will sell the coin. They have to sell more the coins that they get. Total volume, of course, will just be half, right? So that's the counter argument.
Yeah, I think the theory is sound, but it is a big question how significant the pressure is. If stock-to-flow theory works as people would like to work, then exactly this mechanism of selling more or keeping more from miners would lead to exactly the same behavior on the markets, because the halving would be very similar to just keeping half of the coins and not putting them on the market from miners' perspective. So these two theories either both work and have significant impact on the price or not, and I don't know what's the case, but yeah.
Yeah, I mean, so the stock to flow. I mean, okay, you want to jump in? Yeah, sorry.
No, go ahead.
No, I mean, the stock to flow ratio. I've been following obviously also quite a bit, and it's quite famous. My big, I'm a data scientist coming from a PhD in computer science. Is that there are only 4 data points. I'm really sorry to say that. And the 4 data points are, the different halvings. That's fair enough, right? But at the same time, does that really have any reason to kind of, to follow the future? And look at Bitcoin Cash, right? I think it's a good example. They had the halvening, and yes, you can say, and difficulty dropped massively, and the Bitcoin Cash price as well. And now, of course, you can argue, okay, that is a different asset, not as well cared for maybe as Bitcoin, but still, we'll really see it. This is going to be really interesting.
So to just adding some quick color to that, a couple of weeks ago, I checked what the average daily inflows into passive products like Grayscale's and Bitcoin Investment Trust and our own CoinShares XBT provider product plus Cash App. And in Q1, I estimate that there is around 750 coins flowing into those products every day. Now at 1,800 coins like daily issuance, obviously there's a big gap between the two, but at 900, all of a sudden we're nearing 85% of ongoing issuance just being eaten by these inflows. So I just think it's an interesting argument to put up on the side of the stock to flow modeling and an interesting way of thinking about what could potentially happen when you have this type of supply constriction.
Yeah, but because people don't see the ratio of coins put directly to the markets from miners. Right now, it can be different number, very different number than what it's going to be after halving. And so even if the theory works, then we don't have this number to put into the theory, because it doesn't matter how much coins you produce. but it's driven by how much coins you are selling, and it's not at least to me, it's not clearly visible what the number is. You have the insight better, but
I agree. And no one, I think, has that fully visible. All you can do is do as solid of an estimate as you can. I don't know if you guys saw the data that came out from Coinmetrics the other day, where they used analysis of the non-space that the S9s and the S7s apparently go for to try and get an idea of their proportion of hash rate in the overall market. I thought that was a very interesting and data-driven approach to it. So for those who haven't looked that up, you should check it out. So let's talk briefly about edges, because I'm realizing we're actually quickly running out of time here, and I just feel like we're only just getting into things, just into interesting stuff. The way I see it, there are two interesting avenues for edge going forward. One of them being access to capital and financing, and the other one being firmware optimization. And I know that both of these are respective points of specialization. So why don't we ask very quickly, Pavel, how do you think there's more edge to be gotten in the overall market from firmware optimization, or do you think we're getting to the edge there too?
There's still a lot of space in this era, I would say. This is one of the last pieces of the whole like mining ecosystem, which needs to be professionalized more. We are trying to do that. And let's look at the S9s. You can, by running different versions of firmware, you can get, let's say, 20% of hash rate output from the machine just by running different firmware and doing all the proper setup from the hardware perspective. And this is too large to not being used by miners. And this is going to happen for S17s, S19s, all the machines out there. The manufacturers are not using the hardware, or their firmware is not using the hardware on the very edge. And it kind of depends on various miners' risk, how they feel about risking the hardware and pushing the hardware to very limits. There is certainly a risk by running more efficient firmware or overclocking the hardware. Yeah, but there is still a large space, much larger than in any other single point I can imagine right now. With hardware you can get. Because you're obviously dependent on the hardware manufacturers, what they can bring to the market. And if it's going to be 20% better, great. But you as a miner cannot change this. You're just waiting. But firmware optimizations are something what you can do yourself if you dig deep enough.
Yeah, I mean, I think I totally agree with that. And the only issue I see with the mining firms is that, of course, they are running out of time, right? So even, yes, of course, it would be nice if you would have the time of 24 months to get the money back for your machine. But the way it went the last at least 4 years, it went down from 24 months to 18 to 12. And now you're lucky if you get 9 to 12 months out of this machine. So my feeling is you probably want to overclock as much as you can, because you might just have to risk it, right? You just have to risk it and get the Bitcoins as fast as you can. And of course, that again drives up the difficulty again. So you kind of killing your own market, but that's what the miners are facing.
Yeah, this is exactly the competition miners are facing all the time. So if competition is overclocking, you're directly forced to do it yourself as well, because otherwise you are in competitive disadvantage. So if there is a space for running more or getting more hashes from the same hardware for the same investment, you should do it. As a miner, the incentive is pretty clear. So yeah, completely agree.
And then, of course, there's the constant competition in the reinvestment cycle, which again drives up difficulty, which again drives miners to have to reinvest in more efficient hardware, especially if you're sitting at the bit of the higher end of the electricity cost curve. And over the last few years, we've seen a proliferation of financial products for miners that allow them to access capital in different ways than before. Philipp, maybe you can speak a little bit about this. Is this all positive, or does it also introduce some vulnerabilities in the structure of the market?
For sure, right? I mean, so we've worked on multiple deals, helping company to list equity, right, in London and Canada, and that went really well in 18, 19. And you know the examples that were listed, and I think that capital was extremely good for these companies because it was as well equity driven. You have financial markets, so they can always issue new paper, and so they have access to these markets, and that makes it very hard to compete for other players. The second thing is what we have worked on is debt financing. Debt financing is extremely interesting because if you think about it, that you have machines that are 50% profitable, right? Why wouldn't you leverage your current infrastructure with a bit of debt, right? And you pay maybe 5 or 10% even, right? But with 50% profitability, that should be easily doable. Problem, of course, is that again, if your profitability goes down so fast, like it did in the last 24 months in multiple cycles, that you had only 9 to 12 months really to get. Well, you thought you have 18 months to get your money back. With a normal appreciation of difficulty, you made your model. And yesterday, Coinmetrics came out with another index on what they would expect difficulty to change to in 3, 6, 9 months. But the problem is that usually that was always, or in the past at least, in the past 4 years, this was always under the actual numbers. So you were always faced with, I have to get my money back faster than I was expecting. And what happened is we wrote and we helped lending out money to mining companies over 12 months and then 6 months and 3 months, because now everybody got extremely wary of these risks. And so I think it's debt financing is extremely interesting, but only if you can lock in both the Bitcoin price, which you can easily do with the Bitcoin future, but also the difficulty. And Bituda came out yesterday with that they have this first trade. I have to say, sorry guys, we've done it already 12 months ago. We've locked in difficulty levels over a period of time for different mining companies, and that of course is interesting. What we haven't achieved yet though is a contract of 12 months length, right, where you can really say, okay, if I can lock in the difficulty, even if that is 50% above today's level or 100% above today's level, but if you could lock that in and lock in today's Bitcoin price, which and then you can say, I can do a math on, I'm going to produce a certain amount of Bitcoins over these 12 months, let's say 1,000 Bitcoins or 10,000 Bitcoins. And at the same time, I'm taking a short position future position in Bitcoin. I sell these 10,000 Bitcoins at today's Bitcoin price. And then I say, okay, this will make me whatever, $10 million. Then the 10 million, or probably today it's whatever, $9 million. And today, how much do I pay for these machines today? If that is less than 9 million, of course I'm interested, right? Because then I can say, I'm going to lock in 10,000 Bitcoins at $9,000 Bitcoin price. I'm paying right now 8 million. Perfect, right? I'm interested. We haven't achieved that. The longest we've kind of done contracts was 3 months. We're looking at 6 months contracts now. But so this market is only just starting to develop, and but I think that could be a big, interesting new development in the crypto space, because that would mean we're now finally able to sell bonds, right? Yield-bearing bonds against these mining companies.
Excellent. And unfortunately, on that note, we're gonna have to wrap this up. Thank you guys very much for coming. And last thing before we leave, what's gonna happen after the halving?
I think difficulty will drop. Yeah? That is good. But let me just I'll just give you my view, and then Pavel. I think difficulty will drop slightly, but it'll be quickly back up with the S9. Capacity coming in, see a major drop. At the same time, I think 25 to 30% of miners will get washed out. And at the same time, these profitability, like Matthieu showed in his paper, will go up. So I think Bitcoin will appreciate, but it won't appreciate as much as everybody hopes for, right? So I think, 10 to 12,000 maybe towards the end of the year, but it's not going to be, 20,000 plus.
Yeah, I mostly agree with what you just said. I think it would be very similar to what happened with mining space when the price last dropped 50%. It's gonna have exactly the same impact on the mining space. The difference will be just people will execute their prepared plans because everybody knows about halving. So it's going to be slightly different in this sense, but otherwise it's just price drop from miners' perspective. Yeah. So it's going to happen so many times in the future, even with the halving.
Yeah.
So
yeah, it just generally volatility is so high in Bitcoin, right? I mean, if you just compare that to traditional assets, we're calculating the volatility of the top 100 assets, crypto assets all the time. And as in general, 100% volatility. What that means is that the assets double or go to zero with a pretty high probability, right? Over a year. Yeah. So that, so it's a very high vol market.
But
and
don't ever say that Bitcoin is going to go to zero. You'll be so unpopular.
You heard it here first. Statistically, Bitcoin will either double or go to zero this next year.
Yeah.
All right. Thank you guys so much. It's been a pleasure. I wish we had more time, but maybe we can do this again sometime. Yeah. So have an excellent rest of the day to you both.
Hi everyone, my name is Matthieu Jobbe Duval, and I'm the head of financial products at CoinList. Before we get started, none of what I'm about to say is financial advice, and the views discussed are only my own. Today I would like to talk about the Bitcoin futures curve and how it can be used to initiate synthetic USD loans collateralized by Bitcoin. More specifically, I will show that currently it is extremely cheap to borrow USD using an existing Bitcoin position. It's a big program. I only have 5 minutes, so let's jump right in. First of all, where is the futures curve today? So turns out it's pretty flat. Let's take a look. I took a couple of screenshots from BitMEX earlier on. To the left, you can see the June 20 future trading at 88.84. To the right, you can see the September 20 future trading 88.80. All those referencing a spot of around 88.76. So all those three instruments trading within a $10 range. That is a very flat curve. If we were to graph that futures curve, this is what it would look like. The fact that the curve is so flat is actually great news for parties looking to borrow USD using Bitcoin as collateral. Why is that? Well, it's going to be easier if we use an example. Meet Alice. Alice is long 100 Bitcoin, and she wants to use that position to borrow US dollar. Note that Alice does not want to liquidate the Bitcoin that she owns. She wants to use it as collateral to get her hands on US dollar. To do so, Alice is going to a spot exchange and will sell 80 Bitcoin for US dollar. In the process, she will raise $710,000. Now, Alice just created a short 80 Bitcoin position. She needs to hedge that short position. To do so, she's going to send the 20 Bitcoin that she has left to a derivatives exchange. On that derivative exchange, she will go long the September future with a leverage of 4x. 4 times 20 equals 80. Now, Alice is long 80 Bitcoin worth of futures and short 80 Bitcoin spot. Alice is market neutral. Wherever the price of Bitcoin goes, Alice is hedged and generated $710,000 in the process. And voila. That's great. So how much did that loan cost Alice? Well, let's go through the number one by one. First of all, the one thing you have to realize is that a futures, by definition, expires into spot when they go into expiry. The September future on the 27th or 28th of September is going to expire against the spot price of Bitcoin, which means that September futures price equals spot price. So for simplicity's sake, let's just say the market has not changed between now and the 27th of September. As I said, Alice is market neutral. So wherever market Bitcoin goes, it does not matter to her P&L. She's always going to be completely hedged. So let's do the tally. Alice did two transactions, a spot transaction and a futures transaction. Spot, she sold 80 Bitcoin at 88.76. The price has not moved. Turns out, zero P&L on that trade. On the futures trade, she bought 80 Bitcoin at 88.80 spot 50. Now, the current price is the spot price, 88.76 spot 54, which means she lost about $4 per Bitcoin on the futures trade, so around $317 loss. Overall, Alice paid $317 to borrow $710,000 for about 5 months between today and the 27th of September. If you annualize that cost, it's around a loss of 0.1% per year. This is the cost of the USD loan that Alice did through a Bitcoin derivatives exchange. That's extremely cheap. So what does this all mean? Well, let's take a step back and think of who would do such a trade. Who is the most interested in borrowing USD using Bitcoin? Well, intuitively, miners. That's exactly what miners want. Miners don't want to liquidate their Bitcoin because they want to keep the exposure. Themselves and their investors want them to keep the exposure to Bitcoin, to their inventory, but they still need to pay operational expenses. So they need to borrow US dollar using Bitcoin. Now, I'm not saying miners do these trades themselves. They typically go through an OTC desk that will do these hedges on their behalf, taking a good fee in the middle for the trouble. So in conclusion, the fact that the futures curve is so flat means one thing: miners are not currently being active in the USD borrowing market. Why am I saying that? Well, if they were being active, the futures would be a lot higher than they are at the moment versus spot. This is actually a phenomenon that we've seen in the last 18 months until the month of March this year, where the 3 months and the 6 month future were on average between 4 and 10% above spot, giving you an annualized rate of USD borrowing of 10 to 15%. This is now currently, as I said, about 0.1%, which means miners are not in this market. Why are they not being active? Well, it's actually all coming from the massive wave of liquidation that we saw mid-March. But this is a story for another time. Thank you.
Welcome to Onchain Reaction. I'm Philipp Gradwell, the Chief Economist at Chainalysis. I'm here to take you through what's been happening on the blockchain in this last week. Well, to set the scene, the last week, which is the 27th of April to 3rd of May, the Bitcoin price has continued to rise, and it's now approaching its longer-term levels, nearly reaching its 100 and 200-day average. So it appears there's a lot of demand for Bitcoin. But how is the supply reacting? It looks like the supply is meeting that demand, with Bitcoin flows into exchanges also returning to their longer-term levels. We're now seeing in the last 14 days a daily average similar to the last 100-day daily average. Interestingly, flows into exchanges are above their 200-day average. So actually, we're seeing greater inflows to exchanges, while we're also seeing prices that we've seen in the 200-day range. That suggests that there is robust demand, keeping the prices up, even as there's this increase in supply. It looks like liquidity on exchanges is sufficient. We can see that because the Bitcoin trading intensity, that's the number of Bitcoin traded for every Bitcoin that's received on chain, that remains at normal levels. You'll notice it does rise at the weekends, say on the 2nd and 3rd of May, or the 25th and 26th of April. That's because at the weekends, there tends to be less Bitcoin coming into exchanges, but trading still seems to be at slightly higher levels. But in general, the 14-day average is very close to the longer-term averages. Flows between exchanges have increased significantly in the last week relative to the last 30 days. And there's been a $221 million cash out from crypto to crypto exchanges and derivatives exchanges to crypto to fiat exchanges. Derivatives exchanges have actually seen a net outflow of around $61 million in the last week, suggesting that there's deleveraging. Around 75% of that went to crypto to fiat exchanges. So overall, it looks like there's a bit of caution in the market, with some people taking profits and some people deleveraging. But there is overall an increased amount of Bitcoin flowing into all types of exchanges as the price increases. Global flows have also increased. particularly from Eastern Asia, with large transfers to North America. There was actually a net flow of about $84 million from Eastern Asia to North America. Interestingly, there was also a net flow from Eastern Asia and North America to the rest of the world of $42 million. A lot of that will be going to European exchanges, but it's still interesting that there's been an increase in Bitcoin flowing out of the two centers of gravity of the Bitcoin market in Eastern Asia and North America. Also looks like medium-term holders are moving more. The flows of Bitcoin held for less than a year are back to longer-term levels after a reduction in the 4-week average. This suggests that people who have held in the medium term are getting a bit more comfortable, and as prices rise, are choosing to move their Bitcoin again. Last week, we talked about Tether and the fact that there was so much Tether on exchanges that I suspected was waiting to buy. We've seen the price increase potentially driven by people using Tether and, of course, fiat on other types of exchanges to buy that Bitcoin. But looking at Tether, the buying power remains, with Tether continuing to enter exchanges at elevated rates, really quite above, indeed, the last 30-day average, or indeed the 100 and 200-day averages that we've also seen. So overall, it seems that the market is returning to normal after mid-March. Perhaps it's not so normal. There is halving interest. We're just days away from that now, and that's likely generating demand. And my big question is, what happens if that recedes? We've seen from this data that the market can supply Bitcoin, so I'm not so worried about the reduction in supply coming from the reduced block reward. What I am worried about is whether there will be as much interest and buzz around people getting into Bitcoin once we're past the halving. And it looks like some market participants share my caution. It does look like there's been some increased profit taking and some deleveraging as people take flows of Bitcoin away from the derivatives exchanges and away from the crypto to crypto exchanges to the crypto to fiat exchanges.
Hi, I'm Teana Baker-Taylor, and thanks for joining us for Governance and Guardrails, our segment focused on all things regulatory and legal happening in the digital assets and crypto space. I'm delighted to be joined today by John Collins, partner at FS Spector, which is an advisory firm assisting firms like fintechs, regtechs, and financial institutions. John, thank you so much for joining us today.
Teana, thanks so much for having me.
It's great to have you. So COVID-19 has starkly highlighted some serious gaps and limitations in our ability to disperse entitlement and relief payments to large groups of people, and has further stimulated discussions around the digital dollar. Phase 3 of the U.S. relief package includes direct payments to Americans of $1,200, but the U.S. has struggled to get these payments into the hands of people. And Americans have been advised that if they don't have direct debit details on hand with the IRS already from a previous tax return, they could be waiting up to 4 months to receive their relief package. A staffer for Senator Grassley also commented that the US government is considering sending prepaid debit cards because it'll be faster than a check. Last month, 3 legislative proposals were made calling for the creation of digital dollar wallets. These proposals aim to upgrade the delivery and utility of relief and entitlement payments, issuing wallets to individuals as a means to get government stimulus money to them more quickly. Senator Brown and Representatives Waters and Tlaib have all introduced such ideas as part of their larger proposed COVID-19 aid and stimulus packages. So, John, multiple senators have introduced ideas for how a digital dollar could be included within COVID-19 relief and stimulus packages. Could you give us a summary of the most interesting proposals you've seen and highlight some of the key differences between them and why they actually matter?
Yeah, and there really were 3 main proposals that were thrown out there, and they were part of larger bills from those individual legislators. And this was during the time in advance of the last package when people were throwing out a variety of different proposals to respond to the current kind of economic crisis. So they all included these 3, a digital dollar, something that looked a lot like a digital dollar, but what that actually meant and how it would be implemented were different in each one. And so, briefly, the Tlaib proposal from Congresswoman Tlaib called for really what we would think of as a kind of pure central bank digital currency, or CBDC, whereby the Federal Reserve, would directly develop and operate and manage a government digital currency and a wallet system. So, in addition to, issuing debit cards, the proposal called for the creation of a permanent Treasury administered digital public currency wallet system. Okay. And that would be something that would, again, be developed by the Fed, and would be something that would be implemented to every individual in the United States. So essentially what that looks like is a universal Fed account for every US citizen, where the Fed, you would have a bank account, a digital currency account, and the wallets would be managed by the Federal Reserve. One thing that I'd note in that proposal is they did call for this e-cash system to be, quote unquote, privacy respecting, which is worth noting.
What does that mean?
So, it doesn't really go farther beyond just the term privacy respecting, but I think if you look at the current Chinese CBDC that's being discussed, they are very much in control of everything in that network. They can see everything in that network. They can actually, as I understand, include, throttling specific categories of payments if needed. So this, I think, is a gesture towards
a nod toward acknowledging that something is going to have to be in there preventing or protecting privacy.
Yep, exactly.
Okay.
The Waters proposal, and it's worth noting that Representative Waters is the chairwoman of the House Financial Services Committee. Again, it was a larger bill, but the bill did call for the creation of a digital dollar wallet. And again, in addition to sort of the other stimulus payments, ultimately what the bill called for was Treasury to create digital dollar wallets that would be, again, created by the Federal Reserve. A digital dollar is actually defined in the bill, and it is defined as a balance expressed as dollar value consisting of digital ledger entries that are recorded as liabilities in the accounts of any Federal Reserve bank. Say that twice. And then the second definition or subset of that is an electronic unit of value redeemable by any eligible financial institution as determined by the Fed.
Okay, so let's pause there for a second. That's really interesting. And I think that language is really interesting. So an electronic unit of value redeemable by any eligible financial institution. So that sounds like it could allow for a lot of different types of digital currencies and tokens. It sounds like the definition as written might open this up to anything the Fed would allow banks to redeem, right? That's what it sounds like. So is this an obvious candidate for a stablecoin? Could this finally be a good external use case for something like JPM coin, perhaps, or another crypto asset? What do you think?
Yeah, I think certainly if you have a definition that says electronic unit of value redeemable by a financial institution, again, as long as the Fed, that could be any number of different things. It could be all of the things that you just said. Now, I don't know if this was just not a drafting error, but something that involved the drafting that led them to kind of have a broad definition to allow perhaps room for the Fed or Treasury to implement it in some way. I'm not sure what the exact intent was on the part of the Congresswoman, but that definition, in my view and in the view of a number of others, is very open to other digital currencies.
Okay, so hearing about the idea of a digital dollar popping up over and over again in legislative proposals, what do they actually mean by what you just mentioned? Do they know what they're saying when they use this terminology? I don't know, but it does kind of indicate to me that policymakers are becoming increasingly more familiar with the idea of tokenization. and that there seems to be a growing consensus for this kind of innovation around digital money. We're seeing this over and over in new legislative proposals, right? So at a minimum, it seems to be that people agree that payments need to be faster.
Yeah, I mean, yeah, absolutely. And I think, this crisis in particular, it moves very, very quickly. I mean, by the nature, I think, of the virus itself, by the nature, I think, of just the way markets work now, it's moving really quickly. And checks, look, I mean, I think they're just too slow, especially for some people to receive and actually have an impact on their individual lives and the larger, economics. So, separate digital currencies or CBDCs or Bitcoin or all of that, we 10 years past the financial crisis, the payment system and the way people interact with money, whether it's PayPal or Venmo or Square Cash, it's just entirely different. So I think what some of these proposals reflect is an understanding that A, consumers are using money in a different way. And two, wouldn't it be nice if the Fed or the Treasury could just zap dollars into someone's hands rather than even wait for direct deposit or certainly checks?
Sure. Well, and in Europe, I mean, we have, in the UK where I am, we have faster payments. So, those payments are literally instant most of the time. But again, the government struggles a little bit with a big disbursement program when you have, millions of people that are requiring payments. So, we often comment on the US and infrastructure gap between, kind of yesteryear and today. But I don't think they're alone in this problem. And certainly, digitized currencies would enable that to be significantly faster. So what's the timeline for this? We're seeing this pop up in legislation, but I have a funny feeling that it's not going to happen, in this stimulus package, right? Are we talking this year? Are we talking 3 years from now? What do you think the timeline is?
Yeah, okay, I don't know. I mean, look, I certainly do not think that these proposals, and they're going to pop up again. I know Senator Brown has a proposal that's very similar to the Waters one. It does not include that electronic unit of value definition, but essentially everything else is pretty much the same. He said he's going to, reintroduce this idea, and we are going to have another stimulus bill that's kind of already in flight and probably will happen in the next month or two. But, I don't expect those to be in anything that happens over the next year. I do think once we are back to somewhat of a sense of normalcy, there's going to be a revisiting of a lot of different things in the economy and the financial system, especially if we, have a change in the White House. And so I would be very surprised if these ideas in some form or fashion do not continue some kind of momentum, whether it's a part of a task force or, continued conversations amongst industry to present these solutions. I do think it is certainly the continuation and really the beginning of this conversation that will happen over the next, several years.
Okay. So, potentially not necessarily going to happen overnight, but it is a nod by the government that digital currencies have a place potentially in a wider financial ecosystem. And that's certainly positive. I think anytime we have policymakers talking in this language that Representative Waters is using, I think it's pretty encouraging, don't you?
Oh yeah, absolutely. And it's not only Congress. I mean, the Federal Reserve is doing some significant work and hosting conversations around, these ideas. The idea of a direct Fed account is not a new one, but the digital currency aspect of it is new, for sure.
Okay. Well, John, thank you so much for talking us through the nuances around these different proposals. I think sometimes reading, big legislative bills are daunting to many of us. So it's awesome that you've had an opportunity to break it down for us. from my personal view, I think it's exciting that discussions around adopting and implementing digital currencies is continuing to increase. I think that's really positive. And it would be amazing if this COVID crisis, really encouraged our governments to be more nimble and look into the future and medium term of giving people better access to financial services and support that they need when they actually need it, right?
Yeah.
Amazing. John, if people would like to get in touch with you to learn more about this, or perhaps what you guys do at FS Vector, how can they do that?
Yeah, so you could visit fsvector.com, and I'm also on Twitter. It's just John Collins, not the NBA player. We're a bit different. I'm about a foot and a half shorter than him, probably, but yeah, just John Collins on Twitter and fsvector.com. People can certainly get in touch with me on this issue or any other kind of work around the policy world, especially around digital currencies and blockchain. We pay pretty close attention to it.
That's awesome. Thank you so much for joining me today, John. It was great.
Thanks so much for having me, Teana.
Cheers.